Morning, everybody. I hope that you're all well and you've joined us for this summary of yesterday's budget. I'm sorry that we're not all together in one room like we would all like to be, but hopefully for our next seminar that will be the case. Next slide, please. In terms of what we're going to cover, it's very much similar to those to previous seminars that we've done, so you'll know the regime that we follow. I always think that autumn statements are a slightly odd thing, in that if there are any major announcements, either the government has to introduce it halfway through a tax year, which is not ideal, or they give taxpayers 6 months notice in which to prepare, which for some things is very good, but it can promote some inappropriate planning. If you imagine that he'd raised the capital gains tax rate to 45%, can you imagine what planning would have gone on between now and April? So in reality, we don't tend to get those major announcements at this time of the year. What we tend to get are lots of very detailed, specific bits of change of tax legislation. And that's certainly what we got yesterday. So there's certainly things that we can go through in terms of private client, wealth management, employment taxes, VAT, CT, and a conclusion at the end. I've been asked to give a brief introduction. Next slide, please. Oh, sorry, no, I should have said there are questions and answers. We will have a question and answer session at the end, but there is a Q&A function. So if you want to raise questions during the presentations itself, you can do. We'll either pick those up at the end or deal with them during the presentation as it goes on. But there are two ways you can ask questions. So if you want to send those through, we'll make sure that they are dealt with. Thank you. Next slide. And the next one as well. That's great. So normally at this point, we try and set the scene. We try and look at the state of the Northeast economy, and then look at what we would have liked the government to have done in order to improve things for local people and local businesses. This year, the economy is in such a state of flux. It's very difficult to do that. It's very difficult to get a handle on where it is and where it's going. 6 months ago, there was a prediction that inflation would peak about now at 3% and then fall back. And clearly that's not the case. Unemployment was estimated to rise to in excess of 12%. They're now saying that will peak at 5 point something. And growth, which they're now predicting will be 6% this year and 6.75% next year, which is massive for an economy of like ours, is way outstrips what they predicted very recently. So everything's in a state of flux. So rather than look at that, what we thought we would just look at what actually happened to the economy and where the pressures are currently coming from. So post-pandemic, we've seen a massive rebound in demand, and that demand has come faster than the supply has been able to pick up. So demand is exceeding supply. We've had major shifts in the labour market, lorry drivers moving away from long distance tachograph limited shifts to driving vans for Amazon. Businesses inevitably have been keen to take advantage of the ability to raise prices, partly to recoup some of the losses that they will have suffered last year. And normally at this point of coming out of recession, you would say that cash would be in short supply. But actually the social measures that the government put in place to protect business and individuals has meant that everyone's awash with, not everyone, but there are large parts of the economy that are awash with cash. And therefore that's fueling the demand. On top of that, we've got worldwide energy shortage, and the Chancellor tried to portray all of our inflation as being a worldwide problem and not a UK problem. Although it is worth noting that our Brexit issues and the problems we have at borders are compounding the issue. But the end result of that is inflation. And I think it was telling that inflation was the first thing that the Chancellor covered yesterday. Whilst he tried to gloss over it and say that it would go away in time, their view has changed. It was supposed to be short-term inflation that would be starting to go now, but we already know that it's likely now to go through to next year. It's a much bigger issue. It's certainly medium-term rather than short-term. Traditionally, a government would do austerity. They would try to reduce the cash of resources in the market. They would look to raise interest rates, and those would normally be the measures you would take to try and stop inflation. Clearly, at this point of a recovery, there are things that they don't want to do, and therefore they're trying to resist those. Next slide, please. So inflation was mentioned in yesterday's budget, but was quickly glossed over. But it is very important. What does it cause? It causes an income redistribution. Those at the bottom, those with the lowest disposable income, suffer more because what they buy goes up in price. In general, everybody's incomes fall. Real incomes fall in terms of actual incomes rise, but real incomes fall. Investors can make negative returns, but borrowers have to pay an increased cost. There are demands for higher wages, putting more pressure on business. And if our inflation is higher than those around us, our competitive countries, then we will lose competitiveness to them. All of this creates business uncertainty. As I said, the government yesterday, whilst they did mention it, they're relying on the fact that it's worldwide and it will come down with time as supply begins to pick up. But I don't think we can underestimate the issues that would arise if our inflation doesn't fall back. The measures that the government will have to take will potentially have to be severe. They will have a major impact on business and individuals. And therefore, I think it was almost the most important thing that he talked about yesterday. Next slide, please. I put winners and losers because I think it is true that inflation creates winners and losers. I'm not going to go through that. I think the important thing that came out of yesterday was that if our competitiveness as compared to our neighbours falls, it will have an impact on us all. I think the figure he quoted was that if our inflation is 1% higher than those around us, we'll lose 24 billion of activity in the economy. So you can see how big an issue this is. And therefore, that's something we'll certainly need to watch. And they have said that next year they expect inflation to peak at over 5%, giving an average of 4% for the year before falling back. So that's certainly something we need to watch out for. Next slide, please. Being an autumn budget, in addition to the tax measures, there was also a considerable discussion on spending announcements. The government overnight were emphasising their change of strategy in that they're now much more a tax and spend government, which you would traditionally link to Labour rather than Conservative. The Chancellor made a big thing at the end of his speech that he thought that was important at this stage of the economy, although during the term of Parliament he hopes that will change. Tax rates will be reduced and they'll move to a more market-based strategy. But this budget was very much to do with the spending. I don't intend to go through them all that I've got on the next two slides, but there's probably one or two that I would pick out. The top one is to do with considerable spending on transport in the regions. This was announced before the budget. There was a bit of a hassle that he was announcing things before he was telling Parliament. But in reality, the vast bulk of things that were in there we already knew. The big one for the North East was the spending on the Middlesbrough to Darlington Railway, which had already been announced. There were lots of other measures, which again I won't go through, but things like the NHS spending to reduce backlogs wasn't specifically targeted at the North East, but clearly we will benefit from that. And the vast bulk of the spending was of that nature. We should see a spin-off benefit, even if it isn't specifically directed to us. The national living wage increase, I think, reflects the issue I had about inflation, that it tends to impact those at the lower income levels more than those with more disposable income. And therefore, you can see why they're seeking to raise that ahead of inflation. Next slide, please. Again, one or two specific things that were mentioned. I know during last week there was an announcement of more money to help electric car production in Sunderland, which is to be welcomed. The Levelling Up Fund is putting 100 million into 5 projects, 2 around Newcastle, 2 in the Tees Valley area, and 1 in Sunderland. Great to see those things happening, and I think if you're particularly involved in them, I'm sure they're good. It's difficult to see how they're going to have a major impact to really make a step change to our North East economy. Regeneration of Yarm Town Centre, I'm sure is needed, but it's not really a driver for change. So there were lots of things in there, lots of things that we will get knock-on benefits, but I don't think there was anything of a game-changing nature within those spending plans. Next slide, please. This is a bit of a funny slide because it's one that I wrote before the budget. My prediction was that there would be an enormous amount of new rules coming in linked to climate change and the need for net zero. If you look at the statistics, going green is more expensive than not doing that. and therefore it really needs a government initiative, sticks and carrots. Carrots to incentivize us to do the right thing and sticks to stop us doing the opposite. In reality, I think yesterday was a missed opportunity. There was very, very little announced. The things that I've got on this slide we already knew about. There was nothing further announced. They fanfare that there's going to be 30 billion spent, sorry. But again, it's all pre-announced, and there was nothing to actively encourage the normal people on the street or normal businesses to change what they do structurally for the benefit of the planet. And you know, personally, I thought that was disappointing. So with that, we'll move on to the tax issue. So I'll hand over to Chris Hodson to look at the private clients.
Thank you, Andrew. And next slide, please. So we start off with the personal allowances. It looks a boring slide because the figures aren't really changing. In fact, they're not going to change again until 2025-26. But I'll come on to why that's important. Next slide, please. So a person on £15,000 of income are paying about £486 of income tax per year, and that's the same for the coming year as well. Next slide, please. Person on £60,000, we're paying £11,432 of tax, and again, that's unchanged for the coming year. The asterisk there, obviously, because Scotland has different rates of tax and different, so therefore that's just mentioned at that point. Next slide, please. Now, this is one of the biggest revenue raisers in the budget, the fact that personal allowances and basic rate band are staying the same for 4 years, because Andrew mentioned inflation. So if you have inflation of 4% per year for the next 4 years, then by the time you get to that last year, a person who is on the basic rate of income tax, the Mr. £15,000, is paying an extra £400 of tax per year by that point in time. And the person on £60,000, because they're higher rate taxpayers, they're paying an extra £1,600 per year in tax. It's the concept of what's called fiscal drag. And if you don't keep up with inflation with your tax rates, then you're dragged into tax, or you're dragged into higher rates. Next slide, please. So in terms of national insurance, we had some announcements slightly pre the budget, but that's why I mentioned them. So the rates, the bands at which you start to pay NIC are set out below. Next slide, please. The change is that for the coming year, 22-23, we bring in an increase in national insurance rates of 1.25% across the board to pay for extra work for the NHS. So what does that mean for people? Next slide, please. So Mr. £15,000 from 21-22 to the next year has an extra £68 of national insurance to pay, and his employer has an extra £77 of employer's NIC to pay. Next slide, please. For an employee on £60,000, then the employer has an extra £640 and the employee has an extra £630 to pay per year. So that's on top of the increase in the tax because of the fiscal drag that I've already mentioned. Next slide, please. Because the fact that a large number of people operate through limited companies, and people who do that take a basic salary and dividends, they could have avoided this 1.25% increase in national insurance. So therefore, the rates of tax and dividends also increased by 1.25% there, 7.5% to 8.75%, etc. So it's to mirror that. Next slide, please. A change that was announced in the budget last year, but it still continues to impact this year, is the ability to carry losses back. Was extended from a 1-year carryback rule to 3-year carryback rule, so that can be beneficial. Although what we're seeing when we're getting the accounts in from clients is because the level of financial support given to businesses, the number of clients actually with losses is not anywhere near as high as we would have expected, but that facility is there and we can use it for our clients. Next slide, please. Making tax digital for income tax. This is the change in how people report their income to HMRC. We're going to go to quarterly digital reporting. And now we've been told that's going to apply from April 2024. It was going to start from April 2019, but then was put on hold. It was going to apply from April 2023, but then it's been put back another year while people recover from the effects of the pandemic. Next slide, please. That's had a knock-on effect onto another change that's been announced, which is what's called basis period reform. So the method of allocating trading income to tax years is to change into time of the switch to making tax digital. As the switch to MTD is delayed for a year, this change in the basis period reform is also delayed to 23-24. But the effect of the change for some businesses is that they'll have almost 2 financial years taxed in one tax year. You get a deduction for something called overlap relief, which is a period of profits that was taxed twice when you first started in business. But given that's often based on profits from many years ago, the overlap is often a lot less than the extra profit, which is going to be taxed now. And to put that in context, the change, one of the major revenue generating changes from the budget, it's projected to raise up to £2 billion from ZOL. The businesses most affected will be those which have a year end of 30th of April, 31st of May or 30th of June. Any business with a year end of 31st of March or 5th of April won't actually be affected at all because they're already on a tax year basis effectively. Next slide, please. So recognising the impact of this change, there is an ability to spread the increased profit over a period of 5 tax years and to be taxed in those years. And also there is an election available to have it all taxed up front if that's preferred by the taxpayer. That might be if you've got losses carried forward, perhaps. Taxpayers might also look to make increased pension contributions to offset the extra tax payable on the extra profit. But the change hasn't actually given anyone any more cash. It's just taxing the money earlier. So you may not have the funds available to pay the contributions. A business doesn't have to change the counting year end because this tax change, but if you retain a year end other than 31st March or 5th of April, you're going to have to perform apportionment calculations every year. And so most people are likely to make the change. The change produces a situation where 2 sets of accounts will have to be prepared in 1 year. And this catch-up exercise is part of the process, as I say, to get the taxpayers ready for the quarterly reporting under Making Tax Digital. Next slide, please. For capital gains tax, there was a lot of talk before the budget. The annual exemption was going to be reduced. The rate of capital gains tax will increase from 20% to 28% and be aligned with income tax with a rate up to 45%. Business asset disposal relief will be abolished, taking away the rate of 10% on up to £1 million of qualifying gains. So what happened? Next slide, please. Well, none of that happened. The only change that did happen was a 30-day period to file a return with HMRC, setting out the capital gain on the sale of UK residential property, and the tax payable increases to 60 days from the current figure of 30 days. It's basically because the 30 days isn't enough time to compile the necessary information, and they've finally agreed that that is in fact the case. And that applies to any disposal on or after the 27th of October 2021, i.e. budget day. And next slide, please. So again, with inheritance tax, there was no changes in it, but just to reiterate the main points in terms of the nil rate bands, we all have a main residence nil rate band. That's risen to a maximum of £175,000 for deaths on or after 6th April 2020. And the married couple or civil partners can now have £1 million free of inheritance tax when you add up each of their nil rate bands and their residence nil rate bands. Now, of course, those figures are frozen until 2025-26. So again, we have the fiscal drag effect on that. So that will mean that when people will gradually pay more and more inheritance tax over the next 4 years. But that's the end of the private client section. And I'll pass on to my colleague, Jeff Kavanagh, who will talk to you about wealth management issues. Thank you.
Thanks, Chris. Good morning, everybody. My name is Jeff Kavanagh. I'm one of the chartered financial planners in our wealth management team. So as ever, ahead of this year's budget, from a pensions point of view, there was your usual speculation, a lot of speculation about potential changes to various allowances and reliefs. But ultimately, in the end, it was a bit of a non-event in terms of those. And really, we didn't see any big changes announced. So what I thought would be useful to do is just provide a bit of a recap, a bit of a refresher on some of the main allowances and reliefs. Next slide, please. So yeah, so the first slide that I've put up in relation to the lifetime allowance. So the lifetime allowance, that's the maximum amount an individual can build up in pension savings during their lifetime before incurring additional punitive tax charges. So you can see here in the spring budget earlier this year, the lifetime allowance that was frozen at 1,073,000. And that's all the way through until 2026. Previously, had been announced that it was actually going to keep rising in line with CPI every year, but the government froze that. And as you can see on the slide, if you go back to 2011, in that tax year, the lifetime allowance at that point was 1.8 million. So it's come down significantly in recent years, and it's going to capture more and more people, especially in the coming years during that frozen period up until 2026. We've had a lot of inquiries from individuals, particularly with defined benefit final salary pensions, and what they're finding is they didn't realise that they're actually caught by the lifetime allowance, and it's actually pretty easy now. It doesn't take a lot to start falling into that environment, and we've been able to help those individuals just understand their options when it comes to the lifetime allowance. Next slide, please. So yeah, this slide, we're just looking at the annual allowance. So the annual allowance, this is the amount that an individual can contribute into their pensions during a tax year. So again, there's no changes in relation to the annual allowance. The standard annual allowance remains at £40,000. But again, still in force is the tapered annual allowance. Now, the tapered annual allowance, what this is in place is basically to try and reduce the benefit that additional rate really high earners receive from using pensions as a tax efficient way of saving. What it means is for an individual that has income over £240,000, okay, they start to lose their standard annual allowance by £1 for every £2 over. In effect, what that means is by the time an individual has income of £312,000, including pension accrual, they're limited to an annual allowance of £4,000. So that's a massive drop from the standard £40,000. For individuals that are only affected by that and go over the £240,000 purely because of their pension accrual, there is in place a caveat as such that allows individuals where their income, it's called threshold income, is below £200,000. So effectively that excludes any pension accrual. They are not affected by those rules. It is quite a complex calculation, and it's something our wealth and tax team, we regularly work with individuals to help them see if they've got an issue and what planning can be done around that. And the final point on this slide, yeah, this is probably where there was the most speculation, as there has been in previous years in terms of the tax relief individuals receive on their pension contributions. The Treasury each year, it spends a lot of money on giving higher and additional rate tax relief on pension contributions for high earners. There's been a lot of talk, a lot of speculation that the rate of tax relief for those individuals may be dropped, perhaps a flat rate, but this wasn't even mentioned, and that all remains as is. Next slide, please. Yeah, here we're just looking at this, something that the government has been lobbied on for a few years actually in relation to workplace pensions, and for certain low earners where they fall below the personal allowance, they've been missing out on the tax relief provided by the government in relation to the personal contributions that they've been paying into their pensions. Now, this is only applicable where pension schemes are operated using what's called a net pay arrangement. And to resolve this, what was announced yesterday is a new scheme will be introduced from 2025-26 tax year, which will automatically ensure those individuals are actually rebated, so they do benefit from that additional tax relief. Next slide, please. State pension and the triple lock. So this was something that was actually announced last month, but just confirmed yesterday. So the triple lock in relation to the state pension, this is where the state pension is guaranteed each year to increase either in line with earnings, inflation, or 2.5%, whatever's the highest. Now, it was announced last month that the element relating to earnings would actually be frozen and suspended for next tax year and won't be applicable. Now, the reason for that was that the state pension actually could have ended up rising by as much as 8%, which would be very lovely if you're in receipt of your state pension, but it was going to cost the government a lot of money. And that was based on the wage growth and earnings rises kind of coming out of the various lockdowns. So in actual fact, what will happen for next tax year is the state pension will rise by 3.1%, which was the inflation, the CPI figure for September this year. Next slide, please. Yeah, this is my final slide, just in relation to investments, similar to ISAs and the like. No major changes here. Everything stays as is. So your annual adult ISA allowance remains at £20,000. And again, in relation to junior ISA and child trust funds, your annual subscription limit remains at £9,000. And on that, I will pass over to my colleague, Rachel.
That's great. Thanks, Jeff. Sam, if we could just move straight on to the next slide, that would be great. Thanks. So there wasn't anything announced in yesterday's budget which was a surprise as far as employment tax goes, as the changes were all announced over the last couple of weeks. The main thing for employers to take away from yesterday's budget is employment costs are rising. There are multiple things which have contributed to the increase in employment costs, which we've tried to summarise on this slide. But it does partly follow the government's pledge to transform the UK into a high-wage, high-skill, high-productivity economy, as the Chancellor did quote a couple of times yesterday. Next slide, please. So, as predicted and announced earlier this week, it was confirmed that the national living wage and national minimum wage rates will increase from the 1st of April 2020. The national living wage, which is payable to those aged 23 and over, is increasing from £8.91 to £9.50 per hour, which is a 6.6% increase. The Chancellor did confirm yesterday that they do remain on track for the national living wage to reach 2/3 of median earnings by 2024, which is their plan. And that will equate to £10.70 per hour based on the current projections. All other national minimum wage rates are increasing in April 22 as set out on the slide, with the minimum wage rate for apprentices being aligned with that rate that's paid to the 16 to 17-year-olds. So that's an 11.9% increase to the apprentice pay rate. Next slide, please. So as Chris briefly mentioned, on 7th of September the government announced that a new levy, the Health and Social Care Levy, would be introduced, with the government pledging to invest £36 billion that they expect to raise over the next 3 years through the levy into the NHS to help it recover from the pandemic. With the levy only being announced in September, it was believed that 7 months wouldn't be a long enough time for systems to be updated for the new levy. So from April 22, we will see a temporary 1.25% increase in Class 1, Class 1A, Class 1B and Class 4 national insurance contributions, as well as to obviously dividend rates, as Chris mentioned. So employees, employers and the self-employed are all going to be affected by this. Next slide, please. From April 23, once HMRC systems have been updated, the NIC rates will be reduced back down to their 21-22 levels, and a new health and social care levy of 1.25% will be introduced, which will formally be separated out. The levy on earnings will operate in the same way as national insurance contributions do, so the same thresholds, requirements and reliefs such as the employment allowance will apply to the levy. Those who are state pension age, they don't pay national insurance contributions, so the 1.25% increase in NIC from April 22 won't affect them. However, from April 2023, the levy will apply to those who are over state pension age also. The levy is going to be collected via the pay-as-you-earn system for employers and employees, and benefits in kind are also going to be subject to the levy. Next slide, please. So how will the national minimum wage or national living wage increase and the health and social care levy introduction impact employers? So this slide just shows the increased cost to an employer for an employee over the age of 23 who works full-time, being 35 hours per week in this example, who is paid the national living wage. So currently £8.91 per hour, increasing to £9.50 per hour from April 22. So the increase in the national living wage will cost the employer £1,074. The employer NIC on the increased wage, obviously taking into account the 1.25% increase from April, will be £92 more from April 22. So the total cost to the employer in respect of this one employee's wages will increase by £1,166 per annum from April 22, which is a 6.8% increase. Depending on the size of your workforce, obviously these changes may result in a considerable additional cost that you had not forecasted for. So I guess you're probably wondering if there's anything you can do to reduce the impact that the additional employment costs are going to have on your business. Stating the obvious, but would obviously recommend that forecasts and budgets are updated as soon as you possibly can, just so you can see kind of exactly how your business will be impacted by the changes, just to help you plan. Another thing, if you've thought about implementing salary sacrifice schemes in the past, then now might be a good time to revisit seeing what savings that you could achieve by implementing a salary sacrifice scheme. Sam, could we go on the next slide, please? So just briefly, in a nutshell, salary sacrifice or salary exchange, as we prefer to call it, basically involves an employee formally agreeing to give up part of their taxable pay for a benefit. Rules were introduced in 2017, which limited the benefit of salary sacrifice for a lot of benefits, but the benefits that are listed on the current slide do not fall within the rules. So from the list of those that still do attract tax and national insurance savings, the one that's most likely to achieve the greatest saving for an employer when introduced across the workforce is a salary sacrifice scheme for workplace pensions, whereby the employee would agree to exchange part of their salary, which is usually equivalent to the current employee pension contribution that they're making, in exchange for an enhanced employer pension contribution. So as the employee is receiving less pay in exchange for the exempt benefit, from April 22, the employee can benefit from a 13.25% NIC saving, or 3.25% if they're a higher rate taxpayer, on the salary that they've exchanged for that benefit. And the employer will achieve a 15.05% saving on the salary exchange. It is important to highlight, though, that care has to be taken when you implement a salary sacrifice scheme. It does involve a contractual change to the terms of the employment, and also not all employees can be included in the scheme. So, for example, if you have an employee whereby the salary sacrifice would result in their earnings being reduced below national minimum wage, then they would have to be excluded from the scheme. Next slide, please. So on this side, we've just got an illustration of the saving that an employer could achieve by implementing a salary sacrifice scheme for pensions across the workforce. A quick way to estimate the total NIC saving that an employer could achieve is to add up the total of employee contributions and apply the employer NIC payment rate from April 22 of 15.05%. I won't work through this example as I know we are pushed for time today, but it just shows that an employer who has a workforce of 80 employees who earn £26,000 on average, who make employee contributions of 5%, the employer could achieve an employer NIC saving of over £15,000 if they implemented a salary sacrifice scheme for pensions. The slides will be shared with you if you do want to work through this calculation for your workforce. Obviously, it is very, very high level estimate, but you could kind of use this just to give you a rough idea of the savings achievable. And if it's something that you'd like to explore further, then we'd be happy to help you calculate a more accurate estimate of potential savings. Next slide, please. There were a few other things that had already been announced before the budget. So firstly, for company vehicles, the company car fuel benefit multiplier, the van benefit charge and the van benefit fuel charge will all be increasing from April 22 by a small amount. I think we say this every year, but if you do provide employees with fuel for private mileage, it is very expensive benefit to provide, and we do recommend that you review your fuel policy. The other change which had been pre-announced is the extension to the apprentice hiring incentive for employers, which offers grants of £3,000 to employers taking on a new apprentice. So that scheme was originally due to close on the 30th of September 21, but it'll now be extended to the 31st of January 22. And finally, the Kickstart scheme. So that scheme provides funding to create new jobs for 16 to 24-year-olds on universal credit. So that scheme has been extended to the 31st of March 22 instead of the original 31st of December 21 cut-off date. Next slide, please. I'm just going to quickly run through a couple of things which haven't stemmed from the budget yesterday, but they are hot topics in employment tax at the minute, so I thought it would be a good chance just to mention them. Firstly, furlough scheme. I'm sure if any of you were still using the furlough scheme, you'll be more than aware that after multiple extensions, it finally came to an end on the 30th of September. Hopefully you saw our blog earlier in the week and isn't going to panic anyone, but if you think you might have made an error in your claim for September, you will have to amend that claim with HMRC today if you've underclaimed. Although the slide there actually, it says by midnight tonight, what I would say is, I mean, that is what's stated in HMRC's guidance, but in order to increase a claim, you do actually have to speak to an advisor at HMRC. Obviously, they're not there till midnight, so the web chat, they tend to man until 7:30 p.m. and phone lines only until 4 p.m. So please contact them kind of as soon as possible after this webinar if you do need to amend your September claim. Conveniently, you do have longer to amend your claim if you've overclaimed. So you have 90 days from the date that you receive the grant money to let HMRC know you overclaimed and to arrange repayment of the overclaimed amount, or HMRC may charge a penalty. Even if the 90-day deadline has passed, it is important that you notify HMRC of any amounts that you've overclaimed as soon as they are discovered. HMRC do expect to recover 1 billion of fraudulent or mistakenly claimed furlough payments over the next 2 years, and they've already opened thousands of investigations with further to follow. So if your business has been claiming grants under the CGRS, you should carry out a thorough review of all claims filed to satisfy yourself that firstly all grant claims are correct, and also to be ready for an inspection from HMRC. Penalties and interest charges, they're likely to be far higher if errors which have resulted in claims being overstated are discovered by HMRC at a later date. So please do review your claims, and if you need any assistance, get in touch with us. It's not actually on this slide, but it's probably a good time to mention as well for Anyone who's been using the SSP rebate scheme, that also closed on the 30th of September. But for that scheme, you do have until the 31st of December to submit or amend any claims. Next slide, please. Off payroll working. Hopefully, if any of you have any off payroll workers, you will have attended one of the many webinars that we've held on this topic over the last couple of years. So I'm not going to go into any level of detail at all on this subject today. I did, however, want to highlight the fact that last month HMRC started issuing letters to organisations who are operating primarily in the oil and gas, banking and finance sectors to review their compliance procedures to determine that they're correctly operating the off-payroll working rules and obviously applying pay-as-you-earn where applicable. The letters that HMRC are sending are to open compliance checks into organisations to understand the processes when they're hiring off-payroll workers and the process for determining the employment status of those workers. In the first instance, HMRC are requesting for a telephone discussion with the responsible person within the organisation, and they are offering support to get the processes right. Obviously, following those calls, HMRC will then decide whether further action is needed. So that could include a request for further more detailed information for review. Although the letters have only been issued to businesses in certain sectors currently, we have absolutely no doubt that the compliance checks will expand to organisations in other sectors in due course. We therefore advise that you do review your systems and processes for dealing with off-payroll workers now, so that you're ready to demonstrate to HMRC that you are complying with the rules if and when you do receive a letter. If you haven't attended one of the IR35 webinars that I've referred to, then we do have recordings available that can be accessed. So let us know and we'd be more than happy to share links to those with you. And finally, I think, Sam, final slide. Yep. I just want to quickly touch on share options. This is just more of something you may want to look at if you operate a share option scheme, such as an EMI scheme, as opposed to something that you have to. If, as a result of the pandemic, your business has made losses or profits have reduced, it may be possible to agree a lower share valuation with HMRC. So it might be a good time to consider resetting the share options in the business. I'm saying resetting the share options, but please do seek advice before allowing any options to lapse and thinking about granting new options, because it's more likely that a parallel option scheme would be more appropriate, which is where you kind of almost have two schemes running alongside each other. Obviously, what will work best for your business and option holders would need to be considered. And that's all from employment tax, so I will pass you over to our VAT specialist.
Hi, thank you, Rachel. So I'm a team consultant. I lead the VAT team here at MHA Tait Walker. So I'm going to cover now is the key VAT messages and announcements from the budget. Next slide, please. I guess the big news on the VAT front is that there is no big news on VAT. It had been hoped that the government would have used the VAT system as a lever to kind of address some of the key issues facing the UK in particular at the moment. The government, however, has decided not to opt to flex its sovereignty. Once we left the EU, the government essentially had a free hand to make VAT changes, so VAT rate changes and general changes to the VAT system. So some of the things that the government have been called upon to introduce haven't come through. So there's no VAT cut on domestic fuel. So as we're aware, the price of gas has gone astronomically high. The government is essentially going to get a windfall from that through the VAT system. So there had been calls on the government to remove VAT, the 5% rate on domestic fuel, and certain other industries have requested cuts as well on that. There are no new announcements on COVID-19, so no further specific support to sectors other than what was already announced. So there was calls from hairdressing sector, lots of other sectors to asking for additional support through the VAT system. As Andrew mentioned, next week we're hosting the Climate Change Conference, COP26. So the eyes of the world are on us. we were anticipating some VAT changes around energy efficiency, potentially in relation to electric cars. Again, there was no new announcements on energy efficiency measures. There's also been wide-scale calls for cuts on VAT in the construction sector, so there's a large amount of lobbying going on in regards to that. Again, there was no cuts in relation to VAT on construction. Obviously, with the current Brexit position, it was anticipated that the government would have trumpeted its sovereignty and introduced some positive VAT measures, but unfortunately there weren't any to discuss. Additionally, as well, there was no new announcements on Brexit support, so there was no kind of extension to the SME Brexit fund for helping businesses adapt to Brexit and deal with the changes from Brexit. And there was no additional measures in terms of dealing with some of the additional red tape with regards to Brexit. So overall, we can kind of say it's a kind of a budget of missed opportunities. Next slide, please. I mean, in terms of what was actually announced, there was a small announcement in terms of the government will be introducing anti-avoidance measures for free ports. So as you may recall, free ports are one of the government's key strategies for levelling up and global Britain. So businesses that operate in free ports, there's a number range of really useful tax, VAT and customs advantages for operating in a free port. We'll obviously have a free port in our region in Teesside, and there'll also be one in Humberside. The government's announcing anti-avoidance measures just to make sure that businesses don't exploit the free ports, and which disadvantages other local industries. So there are the two announcements which are around the Northern Ireland Protocol. So there's some wrinkles in the Northern Ireland Protocol. As you'll be aware, we've left the EU, but Northern Ireland has remained within the EU single market for goods purposes, which has led to a number of anomalies with trading between Great Britain and Northern Ireland. So one of the ones the government has addressed is a new VAT exemption for the importation of dental prostheses. So it's a good news for dentists supplying between Great Britain and Northern Ireland. A more important measure is the confirmation that second-hand car dealers in Northern Ireland can use the second-hand margin scheme for cars bought from Great Britain. So obviously it's a big issue for car dealers. Strictly in Northern Ireland and part of the protocol, car dealers couldn't use the margin scheme for cars bought from Great Britain, which meant they had to charge VAT on the full selling price rather than just on the margin that they earned, which had obviously a big impact on car dealers in Northern Ireland and businesses in Great Britain that supplied cars to Northern Ireland. So in the interim, the government's announced that they will be able to use, car dealers in Northern Ireland will be able to use the second-hand car margin scheme for cars from Great Britain. This is an interim measure, and it's intended that there'll be a new export scheme for cars to be introduced for sales from Great Britain into Northern Ireland. And essentially what it'll be is a refund which is equivalent to the VAT, though we have none of the details on that. Interestingly, it also references sales to the EU, so we don't know whether that might be a wider expansion to second-hand car sales to the EU as well. But there was also an announcement on a consultation for the VAT exemption for fund management. So overall, in terms of VAT changes, there was a limited number of VAT announcements. Next slide, please. Just to confirm, there was no changes to the VAT registration and deregistration thresholds, so there's going to be no changes for further 2 years from the 1st of April 2022. There have been no changes to the announced VAT reduction for hospitality holiday accommodation that was introduced from the 1st of October, so that's still going to remain at 12.5%, which is a VAT rate we've never had, so it's been quite interesting for businesses to get 12.5% into their accounting systems. And again, this will revert back to 20% from the 31st of March next year. It had been hoped there'd be a wider measure and a widening of the scope of this, but again, there was no further announcements. There's no delay to the extension of making tax digital for businesses that are below the VAT registration threshold, so that will be coming in from the 1st of April 2022. The new penalty regime for late submission of VAT returns and interest harmonisation, they'll still be coming in from the 1st of April 2022. So the VAT rules are being brought in line with the direct tax rules. So if you miss a VAT payment or a VAT return, It's not going to be an automatic kind of penalty. It'll be based on the number of failures, and that'll be level of penalty will ratchet up depending on the number of failures. And just a key reminder as well for any businesses that are selling to the EU, so distance selling. EU introduced new rules from the 1st of July 2021. So if you're selling to the EU, to consumers in the EU, please do get in touch here. There are some important rule changes that are there. And in terms of VAT, that's all from me. So I'm going to hand over to Alistair Wilson, who's going to run through the corporate tax impact on the budget.
Thanks, Hadim. Sam, if we can move on to my first slide. This is really the last 5 minutes in terms of this presentation. The key thing in terms of corporation tax is obviously that corporate taxes are going up to 25% from 2023. Obviously, we've discussed this before in a number of presentations, including the one from the budget in March. Hopefully, everybody's aware that that represents effectively a 30% increase in corporation tax. And the key message is to include that in your cash flows. However, the one thing that did come out in terms of corporate tax for property developers, if you're a property developer and you've got taxable profits of more than £25 million a year from property development, you will be subject to a further 4% charge in the form of additional corporation tax. We can move on to the next slide, Sam. And really, in terms of corporation tax, again, these slides will be circulated to attendees, but one of the key things is to remember the associated companies rules. Whilst your individual entity might be below the threshold, for example, for the 25% rate, if you need to take into account associated companies, in fact, you may be caught by the 25% rate. So just remember, it's not as simple as just what is impacting upon that company on its own. Move on to the next slide, please, Sam. But at the same time, also remember that there are the recently extended rules in terms of loss utilization. Now, there were some changes that were made in 2017, which gave additional flexibility. There were changes made in the budget in March 2021, which has given even more flexibility in using losses in terms of loss carryback rules. All of that is very helpful, in particular for businesses who are in the hospitality, leisure sectors or retail sectors where they may have incurred losses over the last 2 years. So one of the key things is just make sure that you know that there is more flexibility for loss utilization and make sure you know how to use them to optimize the relief that you have. If we can move on to the next slide, please, Sam. So one of the key things, one of the key changes from yesterday, and this is very, very relevant to our region. One of the key changes was in relation to what's known as the creative sector tax reliefs. Now, those are museums, galleries, exhibitions, orchestras, theatres. And you might think, well, why are they getting tax reliefs and special tax reliefs? Well, they've been in place for approximately the last 4 years. For museums and galleries, they were due to expire next April. That has been extended for an extra 2 years. But the way that the rules for those organisations, and I say organisations because typically they're not-for-profit organisations, the way that they work is like the R&D tax relief regime. They get an enhanced deduction for what they spend. They can then surrender that to HMRC for a cash repayment. The big news in the budget yesterday was not only are the time limits being extended, but also the rates of relief are being extended. So that will help a number of museums, orchestras, theatres in our region, and we help quite a number of them. And so that's very beneficial for our region. We can move on, Sam. And then the other major changes in terms of reliefs and incentives. The R&D regime is going to be slightly extended in terms of data costs, and cloud computing costs will be allowed as allowable expenditure. In reality, we don't see that making a huge difference to most claims. Yes, there will be some additional costs, but they're unlikely to be substantial. In reality, the main changes in terms of the R&D regime are actually going to curtail the regime. If you have got a branch where you employ people overseas, that's likely to now be excluded in terms of qualifying expenditure. And likewise, HMRC are going to try and rein in what they see as being abuse and non-compliance with the regime. And the Chancellor specifically highlighted that He was aware of that businesses seemed to be claiming more than they were actually spending on R&D, according to what the companies were telling HMRC and the Treasury. So watch this space on R&D claims. Capital allowances, again, the annual investment allowance was extended in terms of how long the £1 million limit will remain in place, and that's been extended up to the end of March 2023. It's no coincidence that that is the same deadline where the super deduction ceases to exist. So in reality, businesses need to think about, can they accelerate expenditure before 31st March 2023? Because we don't know what's going to happen after that date, and it is a use it or lose it relief. We can move on to the next slide, please, Sam. So I have included a slide that just illustrates the point that if you look at, for example, the R&D tax relief regime, the value of the relief that you're getting today isn't going to increase, but the value of the tax relief, if you took it forward as a loss from 2023, would be more valuable from 2023. But if you surrender it as a loss today, then you could actually be giving some money away. So for companies, we would say just have a strategy in terms of what you're doing with your tax losses, have a strategy as to what you're doing with things like R&D tax relief regimes. Because what you don't want to do is give money away today, which in fact could be worth substantially more in 2023. And so businesses just need to have a strategy and have a think about that. If we can move on to the next slide, please, Sam. And just quickly on business rates. The Chancellor did say yesterday that he was making the biggest giveaway in terms of business rates for a generation. Business rates are always a contentious subject. In reality, the online economy is at a competitive advantage compared to the bricks and mortar economy. He did bring in some temporary reductions for retail, hospitality and leisure properties, which will be helpful to that sector. And that has worked very well in our region in the past, where similar reliefs have been brought in on a temporary rate basis. It is only going to be, however, for what is effectively the 22 to 23 tax year. So it is only temporary in nature. There are some more permanent reliefs that are likely to be brought in for business property improvements and also improvements which help to decarbonise commercial buildings. But in the reality, the main solution is going to be the idea to look at an online sales tax instead. And so that is hopefully something which provides a more fundamental solution. Next slide, please, Sam. So in conclusion, to bring all of this together, one of the things that I always recommend that people look at in terms of the budget is what is the Chancellor doing in terms of what he's spending compared to what he's raising. Whenever you look at the two budgets, the budget was very much revenue raising, the one in March. The one in October was very much spending. If you add together the two, he is spending substantially more than he is raising in terms of tax increases. But those tax increases come in from 2024 and beyond. In reality, the businesses that are going to pay the bill aren't yet feeling the cost. And that will come to play from the next election and beyond. And a cynic would say that might be deliberate because it might get the government re-elected without people having felt most of the cost. And just move on to the next slide, please. If I was advising a business, I would say understand your cash tax charge compared to what your accounts look like. Understand what your tax attributes are. Understand what all of this is going to mean for your business in terms of additional costs. And make sure that you have a plan. Because this is going to cost your business a lot of money, but not for a while. And so put that into your cash flow forecasts. Next slide, please, Sam. So as I say, understand your tax losses. Are you in a position where you understand where they are? Are you in a position where you understand where the attributes would best benefit your business? We can help you do that. And I would say that businesses should understand that as a real key measure. And then move on to my final slide, please, Sam. So the key takeaways from what I would say all businesses should be thinking about now. Wage costs are rising, so are employment taxes. Corporate taxes are going to go up substantially, but there's lots of things that you can do to help your business reduce its overall costs. and I've listed some of them out on this screen. In reality, the key thing would be have a strategy. Make sure you understand what are the things that will help your business to offset the costs which are going to go up. And that's really the key takeaway for businesses and their owners today. If your cost base is going to go up, you can make changes that will stop that cost base going up as much as others might. And that's really the point that everybody should take away from this budget. And with that, I'm going to bring the presentation to a close, but I'm going to move on to questions. So one question which has come in, which is that there seem to be a lot of tax cuts and reliefs. How do you think the government is going to fund this? Are there likely to be further tax hikes down the line? To be honest, I think there is a good chance that some of the things that haven't been done may well be brought in. But would I, as a betting person, think that the Chancellor is going to raise or bring in a whole load of measures in one go? I would say probably not. I'd say he's probably done a lot over the last 12 months in terms of raising taxes. And I think he might now drip feed some measures in. So, for example, the changes in capital gains tax or changes in pensions. So it's being done one by one rather than bringing in the whole range of measures in one go. So the answer to that question in terms of additional measures, I think, yes, there probably will be some, but probably not in a whole sweep of changes like happened in March 2021. I don't know if there's any further questions at this point in time. I'm conscious that we're just at effectively at the hour mark, which is where this presentation was due to end. I would say thank you all very much for attending. Obviously, the copies of the slides will be sent out to all of the delegates who attended. And if anybody else wants further copies, then do please let us know. But in the meantime, I would say thank you very much to everybody who's presented today. And thank you very much for attending. And if anybody has got any further questions, do feel free to email us directly or contact us directly. And with that, I will bring the presentation to a close.